Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 8 years and running. The team from Gulf Coast Financial Services, celebrating their 30th year, saving North Central Florida savers and investors, and getting those plans in place to face the difficulties and challenges that we face in our financial and retirement progress. Founder and CEO John Kuykendall here with us, as always, providing the guidance and information. And John, we always appreciate the time.
Well, thank you. It's great to be here. I know we're going to talk today about inflation, and I'm really excited about that. Inflation has played a bigger and bigger part into all of our retirement income plans, because without covering for that inflation, you can't expect to have a 30-year retirement like you want. So we're really excited today, Peter, to talk about that and get some ideas on what inflation is and, what we need to do to counteract it.
Backing up from a 30,000-foot view and keeping things simple, John, what is inflation?
Well, inflation is when goods in a sector or sectors increase, which because either decreased consumer demand. So as goods rise, consumers can afford less and less of those, but it's caused because of a lack of certain things in the sector. You take during COVID, when we shut down the country in 2020, a lot of manufacturing companies and a lot of manufacturers were out of business for a period of time. When they started ramping back up, we noticed that the employees who they had to let go or had to lay off, or they had taken other jobs or had decided not to come back to work and retire at that point. So it took them longer to get started, longer to build back up to where they could actually produce. And so this created a shortage of goods, which drove the price of those goods up. Case in point, automobiles, which we were talking about earlier, with the chips not being available. And because a majority of our chips are produced overseas, that has created a shortage of vehicles, which has created a higher demand, which has caused inflation.
So a bit of it is simple Econ 101, supply and demand. But where does the Fed and the government and monetary policy play into inflation, either creating it or controlling it?
Well, the monetary committees the Fed decides that they're going to increase interest rates or lower interest rates to either fight inflation or to cause cheaper goods so that there'll be more demand. So, as you know, the Fed has historically set this target of inflation to be around 2 to 2.5%. So Fed funds target, which is the amount of money that the rate that they charge when they loan money to other banks, they raise that up in order to bring inflation down. So the Fed thinks that they can create less inflation by raising and lowering the interest rates on the cost of money that is given to banks, therefore raising interest rates, causing lending costs to be higher, therefore shrinking demand when we have high inflation like we've had in 2022. 2022 is an anomaly. We've been in a low inflation cycle now since probably 2010, and so during that time, inflation really hasn't been a problem. We've been able to outpace inflation because of the demand for the goods. But that's finally caught up with us in 2022, and we have a lot higher inflation than we've had since the late 90s, late 70s, early 80s, or going back to end of World War II, when we had double-digit inflation.
Has the several rounds of quantitative easing and then COVID stimulus played into inflation at all?
Of course. I mean, the easing of the interest rates and the fact that we were at a zero Fed funds rate for a long time, therefore pumped more money into the system and caused manufacturers to ramp up, be able to borrow money at a lower cost, and be able to produce more goods, therefore creating more goods than there was demand. So we had what I want to say is some market analysis. If you went down to take an example, we talked about automobiles. If we went down to buy an automobile a couple of years ago, you didn't talk about manufacturer suggested retail. You talked about the discount off of that amount because there were more automobiles available than there were buyers. Now in this economy today, we're talking about manufacturer suggested retail plus market adjustments for the availability or lack of availability of those vehicles. And so it's created a much higher inflation than we wanted. The stimulus actually put more money in the system, more money into circulation. Consumers could buy more goods. Therefore, that has driven to the point where we have this double-digit inflation.
Zooming in now on a more specific basis, how does inflation affect us as individuals, as savers, as investors, and as retirees?
Well, I think the thing we have to think about, Peter, is that during our retirement, today a dollar is a dollar. But what is a dollar going to be worth in 20 years or 30 years or during my retirement? And so, if I looked at 1992 and went to 2022, if I purchased a $40,000 car in 1992, with the amount of inflation that we've had in our society, that car would cost us $84,000 today. So we've gone from 40,000, we doubled. It's 111% increase. I think that puts it pretty simple, is that we're looking in a 30-year period of 100% increase in what I'm going to need to buy goods.
I think it was the great Yogi Berra who once said, "A dime's not worth a nickel anymore." And he summed it up pretty well. But I remember a time when I could buy a set of 4 tires for my car for essentially the price that 1 tire costs today. So yeah, if we look back in history, a dollar today is worth maybe several dollars 20, 30, 40 years ago. But into the future, we expect to have that same effect, right, except the opposite direction. And that will represent inflation.
That's right. So we're going to need more money in retirement in order to purchase the same amount of goods. And that's how it affects us. And it's especially harsh on retirees because most retirees are on fixed income. They have their Social Security. Very few of them have pensions. And then they have their investment bucket. And so we have to draw out of that investment bucket to make up for what we're losing in purchasing power with Social Security.
How do we combat inflation in retirement? If this is such a challenge that we need to be aware of and face, what do we do about it, John?
Well, I think what we have to do, Peter, is we have to have that income plan that we've talked about all along. I mean, we have to figure out a way to maximize our investments. We can't afford to sit and put our money under our mattress anymore. We need to have it invested. We need to have it diversified. We need to have a safe bucket. We need to have a bucket that's growth so that as our retirement goes on, hopefully my growth bucket will be able to, over time, be able to keep up with inflation. But there are going to be times, such as we've seen in 2022, when the market's not going to do well. And I'm going to be going through a recession, and I need to be able to have other sources of income coming in so that I don't have to pull money out of my growth bucket. And I think that's the biggest thing that most people don't understand, Peter, is that diversification, it doesn't just mean that I've got stocks and ETF, exchange traded funds and mutual funds, it means that I've got different buckets that I'm drawing my retirement out of to maximize my total retirement and to be able to also minimize my taxes.
Different specific tools, strategies, or products serving different purposes to help address this challenge of inflation in that financially focused written retirement income planning process?
That's it. I mean, that's what we do. We look at different products. We look at different strategies on how we're going to withdraw money. Do we take money out of the Roth first? Do we take money out of the retirement accounts and pay the taxes? How do we structure the retirement so that we can diversify it to the point that we're really covered? And also, how are we going to maximize it so that we can pull out the right amount of money and minimize the taxes? We know that taxes are going up. We say that every week. We know that taxes are going to have to go up. We just signed a new bill that's going to put a lot more money in circulation. We got to pay for that. The government doesn't get free lunch. And so there has to be a way that we maximize our retirement and also maximize those monies coming out.
So does the order of operations in what type of accounts and what money we access over our retirement lifespan matter in helping us to address inflation?
Yes, it does. I mean, what we need to do is we pull out from certain buckets in order to minimize our taxes and maximize the availability of our money. In growth times, we want to leave our growth bucket alone as long as we can because it's making the most money. And so we pull money out of our short-term bucket and out of maybe our annuity bucket or some other bucket that we've set up so that we have a fixed income. And then during bad market times, we want to try to leave the growth bucket alone and hit the other buckets so that we can make that growth bucket last as long as we can. We know that through the sequence of returns, if I'm taking money out of my growth bucket and the market's down, my money is going to I'm going to run out of money quicker than if I left that alone and let it recover because the market will recover. Also, we need to have different strategies as far as that guaranteed predictable income. So what that income plan will do is it will meet our daily needs that we set up today. And then the growth bucket and the other buckets we set up will have that hedge for inflation so that as I need more money down the road, I have it. You know, Tom Hegna has said over and over again, there are 3 phases of retirement. And I really believe this. The older I get, the more I understand it. There's the go-go years is when you first retire, you want to just go. And that's fine. We need to plan for that. And then as I get older, my next phase, I'm going to be slow go. I'm going to go, but I'm not going to want to get on that plane as much as I did. I'm going to want to sleep in my own bed and get home. The last phase is the no-go, where we just stay home. And those are our final days and where we just want to be home because of sickness or because of health problems. And so I'm not going to spend as much money. We try to incorporate that so that we can help you dream that retirement. We don't want to be like we've talked about many times, the Halloween bucket where I give out all my candy in the first hour and I don't have any candy for anybody else coming. Or at the end of I got to eat all that candy because I didn't give out enough.
Comparing the financially focused written retirement income plan, John, with most Americans' plans that they have, how do the majority of Americans' retirement plan projections address inflation? And do you feel that approach would be successful?
Well, first of all, I don't think most people plan with an income plan. I think what they plan is that they know I need this much money, or they don't budget, and so we spend as we have before, and we don't have a budget, we don't have a plan. There's no reserve fund for the roof and for the car breaking down, those set of tires you were talking about, and so we retire by the seat of our pants. Procrastination. We don't want to know. We just think we can do it. There is no magic number that anyone can retire on. I mean, some people can retire on $500,000. So I read today that people think the majority of the people think it's going to take 1.6 million to retire. I'm not sure what your number is, but it isn't, it may or may not be that high. It depends on what your needs are and what your wants are. And what most people do in retirement is they don't prioritize their needs from their wants. And so with that income plan, we sit down, we work up a budget, we work up how much you need to spend each month for necessities. And then after we do that, we plan on the wants. I want to go on a trip. I want to buy a new car. We put that in the plan.
Well, John, you make an offer for listeners to the podcast, readers of the book, visitors to your office from throughout North Central Florida to help construct a financially focused retirement plan, specifically with that written income plan component. Can you talk about that process and how people can take advantage?
Well, what they need to do, Peter, is give us a call or email us or go on our website and contact us through the website. And if they want to do a financially focused income plan, we'll be glad to put that together for them. There's no obligation. We just need to gather certain documents. We'll send you a list of what we need. You'll put that together for us, submit it to us. We'll put together a very simple, but a very detailed plan on how your income is going to last during retirement or how much you need for retirement. And then we will present that to you free of charge. And we're very happy to do that. With our clients, we do that ongoingly as we go forward. We want to make sure every time there's a change in something in their life, we've updated their income plan, or if they get a promotion or we have a new kid, sometimes it ends up that we take care of the grandkids. Whatever happens in life, we want to make sure that we're proactive.
So addressing income in retirement, but specifically talking today about inflation, addressing inflation is going to be an ongoing issue and process.
Well, inflation has been with us forever. Now, during the Great Recession or Depression, we had negative inflation, but we haven't had that. There's only been a couple of times in history since then that we've had negative inflation. So if we look at history, inflation will be with us. Whatever it is, we as individuals can't control it, but we can react to it and we can plan for it. And historically, for the last 20 years, inflation's been about 3.8%. So if we plan properly, we should be able to handle inflation in our retirement. But if we don't plan, Peter, then you don't know where you're going. The roadmap isn't there for us. We're just riding down the road.
Once again, ladies and gentlemen, the offer is on the table. If you would like to take advantage of the time, the opportunity to come in and review your plan for income, addressing risks like inflation into and throughout retirement, the team from GulfCoast Financial Services makes that opportunity available to you. A quick phone call, get a couple direct questions answered, set up a time that is convenient for you, taking a look at all of the assets, investments, and retirement accounts that you have, helping you review and analyzing them, putting them in the correct order of operations, and then showing you a detailed written plan on how to generate lasting, durable, dependable income throughout retirement. If you'd like to take advantage, pick up the phone, give a call, 386-755-9018. That is 386-755-9018, 386-755-9018. John, appreciate the conversation about a topic that we are all learning a little bit more about and facing as we have come through the couple years since COVID. Inflation, certainly something that we need to factor into our retirement income plans for the future.
Well, that's right, Peter. If we don't plan for it, there's no way we can be ready for it. We need to plan and get that set up so that no matter what inflation is, we're going to be able to handle it and we're going to be able to have the retirement we want.
Well, we always appreciate the time and the insight. Once again, ladies and gentlemen, the team from GulfCoast Financial Services, your resource and here to help. Looking forward to hearing from you. 386-755-9018. That is 386-755-9018. You can find them online at gulfcoastfinancial.net. John, we appreciate the time.
Thank you.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.